Fusion Mobile, quality e-learning experience on the go.
You are welcome to Fusion Mobile e-learning platform. I'm Olokobi Pelumi by name, the accounting tutor, and in this class we'll be treating depreciation of fixed assets. And we'll be looking at the meaning of depreciation, the causes of depreciation, element of depreciation, method of depreciation, recording depreciation in the book of accounts. First thing, we have the meaning of depreciation. Before going into the meaning of depreciation, let's look at the word fixed asset. So fixed asset is just a form of what? As a form of asset. And generally, this category of assets are usually permanent in nature, and they are used in generation of revenue for the organization. So, although these assets are fixed, that is, it can be used for more than one accounting period. So these assets, as a result of constant use, are subject to what? Wear and tears. That is, they can easily be worn out as a result of constant use. So, as passage of time goes on such a fixed asset, this asset continues to experience what we term as depreciation. So, depreciation is the continuous fall in the value of an asset, in the quality of an asset, and also in the quantity of an asset. So, you can then move to the causes of depreciation. What actually brought about the word depreciation? Why do we have a reduction in the value of an asset that is used by the business? Why do we experience, or why do we have a reduction in its value? Okay, number one, we have wear and tears, which I've said earlier. Wear and tears. This cause of depreciation is as a result of constant use. If the assets are put in use in the business within a certain period of time, what happens? Such an asset continues to work or start to worn out. That is, there will be a reduction in value as a result of its constant use. Then we can also have the passage of time. Passage of time. Yes, with time, an asset or a property of the business do experience some reduction in its value. An asset that is bought in 2010, when it gets to 2016, we should be expecting that there should be a reduction in the value of the asset as a result of the passage of time. So with time, an asset do depreciate in value. Then again, we can move to inadequacy. Yeah, an asset can become inadequate for an organization. Maybe the organization experienced some expansion. So, an asset, a property of the business, might become inadequate due to some certain reason, and that calls for replacement. So that means the old assets will have experienced some certain amount of depreciation, because when the asset has been sold, what will happen? It might not be able to cover its original cost. So that means the asset that also experienced the amount of depreciation. So the next one, we can look at obsolescence. Look at obsolescence. So we can look at obsolescence. So an asset also experience depreciation as a result of obsolescence. That means, as a result of change in technology, what happened? An asset might become might not be able to satisfy the organization any longer. That calls for replacement on the asset. Like in the period of 1990s, what happened? The railway, that is the railway authority, make use of engine that make use of coal. But this is changing technology. What happened? We have engine that have what, that uses diesel. So what happens? It means the engine that uses coals, there will surely be a reduction in value. That calls for replacement to have a new technology. So there might be a new technology, change in technology, which calls for a replacement for an asset, because the change in technology or the new asset will be able to perform well and produce more of the goods than the inadequate asset or ancient assets being used. So we can look at the element of depreciation. That is, what elements are we to consider if you have to calculate depreciation, or if you have to find the value of depreciation? What are the things we have to consider? Which term as the element of depreciation? So we have 3 elements of depreciation. So these are the 3 values we have to consider while calculating depreciation. So the element of depreciation, so we have original cost, that is the cost of the asset. That is the historical cost of the asset, has to be considered. Also we have the scrap value or the residual value. The residual value or the scrap value. Then we have the estimated useful life of the asset. So that means generally, when consider depreciation, or when consider to calculate the value of depreciation, these 3 elements must be taken in consideration. So the first element we have is the original cost or historical cost. So this is the amount of money incurred in the acquisition of the asset. That means that cost will include the cost of purchase and also the cost of carriage. Okay, which is the original cost of the asset. The next thing we have the scrap value and the residual value. This means the amount in which the asset is to be sold at the end of its useful life. If an asset is to be sold after 5 years of its useful life, that means the value in which the asset is having after 5 years, that becomes the scrap value or the residual value. That is the amount in which the asset is to be disposed of when it gets to its end of its useful life. You can also call it the disposal value or the estimated value after the useful life of the asset. The next thing we have the useful life of the asset. That is the expected number of years in which the asset is said to be used in the business. So we have to estimate the number of years we have to use the asset in the business. That also have to be taken into consideration. So this is 3 important elements we have in calculating the value of depreciation. So we can move to, we have next thing we have is the method of depreciation. Method of depreciation. So we have different methods in calculating depreciation. The first thing we have the straight line method. Next thing we have diminishing. So we have the method of depreciation. We have the straight line method, the diminishing or reducing balance method. Okay, we have the sum of the year digit method. So we have evaluation method. Okay, we have we also have analysis method, which is an advanced one here. Analysis method. We also have we also have seeking fund method. Seeking fund method. and so on and so forth on that. So the straight line method, let's talk about the straight line method. In the straight line method, a fixed amount of what value is charged as depreciation in the useful life or in depreciation. That is, an equal amount of depreciation will be taken in each year of the useful life of the assets. So the straight line methods give us an equal amount of depreciation, and that can be calculated using the formula cost minus scrap value or residual value over useful life. So we can calculate the depreciation value using that formula when using the straight line method. So that straight line method gives us an equal amount of depreciation in each year of the useful life of the asset. Now we have the diminishing or reducing balance method. The diminishing or reducing balance method does not give an equal amount of depreciation, but rather the amount of depreciation in each year diminished or reduced as the number of useful life of the year progress, or as we have a progressive number of useful life of the asset. That means in the first year of the asset, what will happen? We're going to have a larger amount of depreciation to be charged in the first year. In the second year, the amount of depreciation will be reduced. That means the amount of depreciation in the second year will be less than the amount of depreciation we charged in the first year of the asset. And again, in the third year, what will happen? The amount of depreciation will also be less than the amount of depreciation charged in the second year. And that means as we progress with the amount of useful life of the asset, what will happen? The amount of depreciation will be charged will continue to be reduced. That is the reason why we have it as diminishing or reducing balance method. So using this method, we can use this formula in calculating the value of depreciation, because a fixed percentage is always given. So the way we can calculate the percentage is to use this formula, the 1 minus the n truth, that is number of year, over the scrap value, the scrap value over the cost, the original cost of the asset. So this can be shortened as 1 minus n truth s minus what? C. X is the scrap value, C is the cost as being explained, n the number of useful life of the assets, and we have 1. Then all multiplied by what? By 100 over 1. All multiplied by 100 over 1. So we can use that to get the fixed percentage. So the next thing we have is the sum of the year digits method. The sum of the year digits method is also the popular method of what? Calculating the value of depreciation. We can use that calculating our value of depreciation. That means the number of useful life of the asset will be added together. If at all the asset is to be used for a period of 5 years, we have the first year, the second year, the third year, and the fourth year. So we also have the 5th year. So what will happen? We have to find the total of the year. That they give us okay. So the number of year we have to be what? We have to go in a reversed order. We take it into a reverse order. So the first year we take 5, the second year we take 2, we have to take 3, then 4 and 5. So we add it together. We take the second year we take 4, and this take 3, and we have 2 and 1 up to the 5 year. So we have to calculate the number of the digit of the year in a reverse order. So we add everything together, then 5 plus 4, that gives us 9, then 3, 12, 14, 15. So to calculate the value of depreciation in the first year, that will give us the 5 ascribed to the first year times over 15 times the cost of the asset. So we are going to add this for the first year, 5 over 15 times cost minus the scrap value if given the scrap value. So that will give us the depreciation for the first year, and second year that will give us 4/15 times cost minus the scrap value, and it goes like that. So that means the digit of the year it goes in the words in the reverse order. So the first year we take the digit 5, which is for the 5 years, and the second year we take the digit 4, and so on like that. So the next thing we have is the revaluation method. Okay, this method is actually used for used tools or stock in valuing stock. So the revaluation method is actually not easily be calculated because the assets that is in loose use or the asset in the business will be revalued by an expert in the business. So value will be attached to the awards to the assets within a period by an expert. So we can compare whether the original value, whether there is an increase in the value of an asset or there is a reduction. So in this, when there is evaluation, the asset can either depreciate or appreciate based on the equity of the expert in the business. Now we have an illustration. A motor cost 6,400 in 1991. It will be kept for 5 years and then sold at the residual value, that is the scrap value, of 200 naira. Calculate the depreciation value in each year using the straight line method, reducing balance method, record in the books of account. So that means we have to calculate the value of depreciation in each year using these two methods, and also we have to record this in the books of account using each method. So the straight line method, the solution using the straight line method, we are going to add the depreciation value, which is going to give us the cost minus the scrap value or residual value over the number of useful life. So we have C minus X over N. So in the illustration, we have the cost to be 6,400 minus the scrap value, which is 200, over the number of useful life, which is 5. Then we have that is going to give us 6,400 minus 200 divided by 5. Then we have 1,240. That will be the equal amount that will be taken as depreciation up to the number of useful life of the asset. So we have 1,240 to be taken as the value of depreciation for the period. So we have because in each year using the straight line method, there will be an equal amount of depreciation in the year. Okay, so we can prepare the depreciation schedule. We have year. So we have 1 and 2, 3 and 4 and 5 as the year. So we have the cost of the depreciation. The cost is 6,400, 6,400, and 6,400, 6,400, and 6,400. Okay. We also have depreciation. Depreciation, we have 1,240, 1,240, then 1,240, 1,240, 1,240. So we can have accumulated depreciation. Accumulated depreciation. So 1,240 will be this. 1,240 plus 1,240, that should give us 2,480. Then 1,000 plus 2,480 plus 1,240, that gives us 3,720 plus 1,240, That gives us 4,960 plus 1,240. That gives us 6,200. So we can find the residual, the net book value of the asset. Well, after the charging depreciation, what will be the value of the asset? So we revise as what? NBV, the net book value. So we have 6,400 minus the accumulated depreciation, which is 1,240. The value now at the end of year 1 is 5,160. What is the value now at the end of year 2? We have 6,400 minus 2,480. The accumulated, we have 3,920. You can also get the net book value in year 2 by subtracting the depreciation for year 1 from the net book value in year, the depreciation value in year 2 from the what? From the net book value in year 1. So we can also calculate the depreciation value, that is the cost 6,500 minus accumulated depreciation, which is 3,720, which is 2,680. You can get that also by subtracting the depreciation value in year 3 from the net book value in year 2. That will give us 2,680. So also in year 4, the cost 6,400 minus accumulated depreciation, that gives us 1,440, which is the net book value of the assets in year 4. In year 5, the net book value, that gives us 200. 6,400 minus 6,200, which serves as the what? The residual value of the asset at the end of the useful life. Now we can record this in the book of account. So the book of account we have to open is the asset account. We have to open the asset account. Thereafter, we have to open the provision for depreciation account. Then we can open the P&L account and open the extract of the balance sheet. So let's open the asset account, that is motor car account. So we have RDR, debit and credit, and in the ledger. So we have the value of motor car was 6,400, and the double entry principle is for us to what? To credit the capital cash account and debit the motor car account, because the motor car will you bought either by cash or on credit or entered by amount in the bank. So let's assume it's being bought by what? By cash. So we have 1991. We have 1991. So let's say it was in January 1. So we have cash. So we have 6,400 as that. So that is all about the motor car account. So the next thing is for us to prepare the provision for depreciation accounts. So we have to have provision, because in our provision, the treatment of the provision in last class, we said provision for depreciation value serve as provision. Yeah, serve as provision. That is, we are making for provision for liability. That means while making provision for assets is also a liability that will occur, because you have to make provision for that, because the value will reduce. We know in certain that the value of the asset will reduce in the future. So we have to make provision for that, which serves as a liability to the business. So we have to make provision for that. So that means the depreciation serves as an allocative cost of the asset over its useful life. So you have to allocate the cost of an asset over its useful life. So recharging the depreciation by allocating the value of the asset, because when the asset is bought, we have to spread it over its number of useful life, because the asset will not be used in a single year in the period. So the value of the assets have to be allocated within a period of time is going to be used in the business. So we have the provision for depreciation account, which is the next account we have to prepare in the book of account. Provision for depreciation, credit and debit. So we have okay. Also we can have our P&L account in this place, profit and loss account and extras. So have the profit and loss account The first thing we have here, we have 1991. So as December 31st, what happened? We have a depreciation value which is 1,240. So that will be taken to P&L account. So what we are going to do is for us to credit provision for the depreciation account and debit P&L account. So we have P&L here, which is 1,240. Then come to the P&L, 1991, provision for depreciation. Provision for depreciation, then we have 1,240. That will close. So the next thing for us to balance our account in the in the provision for depreciation account. Also at the start December, we have balance carried down. So which is 1,240. So we can close that. Then the next thing we can bring it down at the year 1992 at January 1. So balance brought down, which is 1,240. So in year 2 also provision is being made. In year 2 also provision is being made for depreciation in year 2, which is 1,240 also. So that will be December 31st. What we are going to do again is for us to credit provision for depreciation account and debit P&L account with the new amount of depreciation for that year. So with the P&L, which is 1,240, then come here 1992. In the year 1992, we go to the P&L account, P&L account, that is profit and loss account. We are going to do that at the same provision for depreciation. So we have 1,240 in that year. So the next thing for us is to balance this account now. So 1992. So we're going to have balance carried down. So we have 2,480, which serves as the accumulated depreciation for the period. So we're going to have 2,480. We have 2,480. So 1993. So we have January 1, balance brought down. So in 1992 we can have 1993. We can have balance January 1. We can have balance brought down. That gives us 2,480. So in the year 1993 we also have the depreciation value, which is 1,240. So we have December 31st. That will be taken to the P&L account, which is 1,240. So we go to the P&L 1993. We have another provision for depreciation. In the year 1993, we have provision for depreciation. It's 1,240. We close that. Then we can balance the account in the year 1993. So 1993, we have balance carried down. That will give us 3,720. That serves as accumulated depreciation. So we have 3,720. So we have 3,720. So the next thing we have 1994. 1994 we have January 1. We have balance brought down, which is for the year 1993. We brought it down to the 1994, which is 3,720. So the next thing we have another depreciation for that year 1994. So we have December 31st. P&L, that will be taken to the P&L account. That will give us 1,240. So we take that to the P&L account 1994. So we have provision for depreciation. So we have 1,240. So we can balance this account now in year 1994. We have balance carried down. So we have now going to give us 4,960. So we can balance the account now. 4,960. And that gave us 4,960. So the next thing we have 1995. January 1. Then we can bring this down as a new balance in the year 1995. So we have 4,960. So we have a new provision for depreciation in that year also. That will be taken to the P&L account. 31st, we have the P&L. That will give us 1,240. So In the P&L account 195, you have another provision for depreciation, and that gives us 1,240. So we can balance the accounts. 1995 now we have balance carried down. So that gives us 6,200. So we have 6,200. We have 6,200. So 1996 January 1, you can break that down at the balance of depreciation, 6,200. I think that is all. So we are done with provision for depreciation and the P&L account. So the next thing is the balance sheet extract. So we can have the balance sheet extract, how it's going to appear in the balance sheet in each year. So we can open our balance sheet. So in the year 1991, it's going to appear as thus. So we have motor car. The value is 6,400. So less depreciation for that year. Again, less depreciation for that year, which is depreciation value for that year is 1,240. That gives us the net book value. I think the net book value is that gives us 5,160. So again, have 5,160. So in the year 1992 also, we have a motor car. The value was 6,400. So again, less depreciation, less accumulated depreciation this time around. And that accumulated depreciation in the year 1992, you can take a provision. That gives us 2,480. 480. So we have the net value for that year. That gives us 3,920. So we have 1993. We have a motor car. So that gives us 6,400. So less accumulated depreciation for that period. So accumulated depreciation for that period can be taken from the schedule. That is the year. Okay, we can take that from here also. That gives us 3,720. That gives us the net book value. And the net book value is for the year 20, for the third year exactly. That gives us 2,680. So for the fourth year, 1994, we have motor car, the value, which was 6,400. So again, less accumulated depreciation. 1994, that was 4,960, and that will give us 1,440. So that's the net book value. So this is the value we are going to have in the first year, the remaining value in the second year, in the third year, and the fourth year. So in the fifth year, so you have the motor car, going to be 6,400, less depreciation. That will be accumulated depreciation. That is going to be 6,200, and the net book value is going to be 200. So that is all about the straight line method of depreciation and the recording in the book of accounts. So we replace the schedule, then thereafter I will move to the motor car accounts. We prepare the provision for depreciation account, the P&L account, then thereafter we did the extract of the balance sheet. So we can move to the other method, reducing balance method. The reducing balance method, we can move to the reducing balance method. The reducing balance method. So in the reducing balance method, we have the formula 1 minus n truths of the scrap value over the cost. So we have 1 minus n is 5, the fifth root of scrap value, which is 200 over 6,400. So we have that will be equals to, okay, can have this times 100 over 1. So that gives us 1 minus the fifth root over 200 divided by 6,400. That gives us 1 over 32. So times 100 over 1. So we have 1 minus the fifth root of 1. What number are we going to multiply by itself in 5 places to give us 1? Is 1 itself. 1 over the fifth root of 32. What number are we going to multiply by itself in 5 places to give us 32? So that is 2. 2 times 2 times 2 times 2 up to 5. That gives us 2. So we have 1 over 2. So the fifth root of 1 over 32, that gives us 1 over 2. So we have times 100 over 1. And now 1 minus half, that gives us half, times 100 over 1. Then we have 50%. So to calculate our depreciation, we have to use the 50% in calculating depreciation. So we can move on. So in year 1, so the depreciation value in year 1, we are going to have cost. Depreciation value will be, okay, we have cost, then which is 6,400. So we are going to have depreciation. This is going to be, which is going to be 50% of the cost. I think that will give us 3,200. So in year 1, the depreciation value is 3,200. So when we subtract, that gives us 3,200. Now year 2, so we have depreciation in year 2. That will be 50% of 3,200 of the net book value. That will give us 1,600. So we have 1,600 itself. Can we see that the balance of depreciation gets to reduce as the number of years increases? In year 1, 3,200. In year 2, it reduces to 1,600. Now in year 3, depreciation value in year 3. So we have depreciation. In year 3 depreciation, we have 50% of the net book value, 1,600, then we have 800. So when we deduct that, that gives us 800 as the net book value in year 4. In year 4 now, we have depreciation. So, and that gives us 50% of 800. That gives us 400. Then we have 400 itself. There's the value. So in year 5, we have depreciation, which is going to be 50% of 400, and we have 200 in year 5. And what we have 200 as the residual value. So the value at the end of the year. So the residual value is actually 200. So we are done in calculating depreciation. So we can prepare the depreciation schedule in that year. We can prepare the depreciation schedule. Depending on the schedule, we have the year, which is 1, 2, 3, then 4, up to 5 years. We have the cost of the depreciation, which is 6,400. 6,400, 6,400, 6,400. So we have 6,400. The next thing we have, so we have depreciation value in the year. In the first year, it was 3,200. It gets to reduce to 1,200, reduces to 800, that reduces to 400, and that also reduces to 200. We can have the accumulated depreciation in that year, so that gives us 3,300 in the first year. That becomes this plus this, that becomes 4,800. That becomes 5,600. This plus this, that becomes 6,000. That becomes 6,200. Now we can add the net book value. The net book value that gives us 3,200 in the first year, which is what we have in the first year. Net book value. So this is the net book value. Not charging depreciation. This is the net book value in the third year, net book value in the fourth year, and the net book value in the fifth year. So the net book value now in this place is 1,600 actually. Net book value here is actually 800 in the third year. In the fourth year, we have 400 in the fourth year. Okay. Actually, the net value in the fourth year is 400, and in the fifth year, we have 200 as the net book value. So the next thing is for us to prepare to record this in the book of account. So we have to record this in the book of accounts. So recording this in the book of account involves us preparing the asset account, similar to what we did, but the differences there is change in depreciation value. There is a change in depreciation value as a result of change of method. There is a change in depreciation value as a result of change in method. So motor car accounts will be the same. So we are going to have depreciation accounts. Provision of depreciation will be the same as in straight line method. So although we have to prepare the motor car account, but that will be the same as in straight line method. So we can go to the provision for depreciation. Our depreciation account, we have the credits and we have the debits. So we have the provision for depreciation account. So we have P&L account. So we have the P&L account. So in the first year, depreciation value is we have 1991, and the depreciation value was December 31st. That is, we take that to the P&L depreciation value for that year. So we're going to have that was 3,200. So we take that to the P&L account. So we have provision for depreciation for the first year. We have 3,200. Then this is closed. So we have to balance this account now in 1991. Balance carried down. So we have 3,200. And we can close this. We can close that. So in 1992, we're going to have January 1. We're going to bring that down. Balance carried down. Then we have 3,200. So in the year, okay, balance brought down. Sorry. So in the year 1992, there's another provision for depreciation, which is 1,600. So we are going to take that to the P&L account. So December 31st, we have the P&L, so which is 1,600. So we take that to the P&L account. 1992, we have the provision for depreciation in the year 1992. So we have 1,600 in that year. The next thing is for us to balance this account. So we have 1992 balance carried down. We have the addition. So that gives us 4,800. So we have 4,800 at the balance carried down. So we have 4,800. So you can bring it down in the year 1993. So January 1 balance brought down. So which is 4,800. So we have which is 4,800. So in the year 1993, there's another provision for depreciation. So we can take that to the P&L account, 31st P&L account. We have that was 800 in that year. Depreciation for that year was 800. That will be taken to the P&L account. So we have 5,600. So in the P&L account 1993, so you have provision for depreciation. That will give us 800. So we have 1993. We have balance carry down. That will give us 5,600. 5,600. So that goes that way. Then the next thing is for you to have 1994 January 1. You have to bring that down. Balance brought down as the accumulated depreciation. So you make provision for the what? For depreciation. So and that for 1994, which is going to be 400. Then you take that to the P&L accounts. So you have to apply the double entry principle by crediting provision for depreciation account and debiting the P&L account, just like the way we did in the straight line method, up to the year of the useful life of the assets, which is 1995. So the next thing is for us to open the extract of the balance sheet. So you can complete this yourself. It's similar to the straight line method. The next thing is for us to open. So we have 1991. We have motor car. The value of motor car in that year was 6,400. So we less depreciation for that year, and that was 3,200, and we have 3,200 as is net book value for that year. 1992, we have a motor car, and the value of that motor car was 6,400. So we are going to less accumulated depreciation for that year, and that will be 3,200 plus 1,600. That gives us 4,800 for the second year, and the net book value that will grab 600 in the second year. In the third year, 1993, we have motor car. So you have 6,400 less accumulated depreciation, and that will be 5,600. So we have 800 as the net book value. So it goes that way. So until we get to the year 1995, which is the end of the useful life of the asset. So this is an interesting topic in accounting. We talk about depreciation, the cost of depreciation, different method, the what used in calculating depreciation, which is the straight line method, some of the year digit method, evaluation method, annuity method, and seeking fund method, which although we don't have the time to treat now, and that will be an advanced topic. So when I get to university, we talk about much of the what of the type of depreciation, like the seeking fund and the evaluation method. So if you're having difficulties as regards to this topic, you can repeat the video for better understanding, and some exercises will be displayed on the screen. Do well to attempt such questions. Thank you.